Hey folks, welcome back to Money and Politics. I've been having a little trouble with my mic today, so hopefully it stays on. I want to focus just for a moment on this slide that often in the past I went over quickly, but again, to point out, I'm not a financial advisor. The discussion's here for educational purposes, and any investment decision is yours. Any gains you make are yours. Any losses you incur are yours. I don't make your decisions to invest. You make those decisions to invest. You make a financial decision based on what you want to do, and don't tie that into just one opinion. Get the opinion of others. The discussions here are of a general nature, so you can read that. But I wanted to underscore that because I heard some comments on Twitter. I haven't spent a whole lot of time focusing on them. I've been covering the fall election, and now I can have the time to come back to you. Someone accused me of being a pumper and a dumper. I'm not a pumper and a dumper, never have been. I believe in buying and holding long term, and I have never sold. I haven't sold any shares of Humble in the last year. Let's put it that way. I haven't. The last time I sold any shares of Humble were right after I sold 1,000 shares, right after the first reverse split. I will go back and cover Humble in a later, after Thanksgiving, because we're going to run out of time. I need to get caught up on Humble because I've been busy. I haven't been able to follow some of the things that have been going on. I'm aware of some of them, obviously, but I want to get myself up to speed. So I'm not going to spend a whole lot of time about Humble tonight. But I did want you to know I'm still holding on to my shares. I did tell you when we're dealing with Humble, it was a startup company. As you know, it started from a SPAC 2 years ago. And so it was always a high risk proposition. It was a high risk, high reward kind of a investment vehicle. It may still prove to be a very profitable investment vehicle. There are many, many instances where people have launched companies, they initially go down, and then they go up. We saw that with Amazon, among others. So I don't want to spend too much time on Humble tonight, other than to say I need to get caught up before I give another video. I want to make sure I'm on more firm footing of what my understandings are of some of the recent developments, and that, that was always a risky investment. So let me pause there, because otherwise I'll go off on a tangent I don't want to go off on. That said, I do want to get caught up tonight on a couple of things. And one of the things I want to be talking to you about are some of the investments that I like going forward. Now, I like INMD. I talked to you about that before. That can, as you get older, your jawline sags, you get bags under the eyes, and you can have INMD is where you do electronic, almost like electronic plastic surgery, and they can resculpture not only your face but different parts of the body. INMD, INMD. And there's been some news coming out. One of the things that came out just today is from the Motley Fool. And so let me bring that up here, that we have the Motley Fool discussing up 58% in 6 months. Is INMD still a bargain stock? And they have an article that you can hopefully find by Alex Cardisi, if I pronounce that right. The key points: INMD shares were hit hard by the bear market, but its long-term outlook remains favorable. Its products are gaining traction among its customers, and its recurring revenue is rising. And third, the company's low valuation means now is a good time to consider buying the shares. I have let's see. I have a chart here I want to go over, which includes, so INMD I'm very keen on. The other, let me bring up the lower graphic here. FNGU, which is a ETN, exchange traded note. That's the one I've talked to you about before, which has 10 different companies. All of them have a 10% position. Twitter, which I never liked, was one of the 10. That is going to have to change now that it's not going to be publicly traded. So I don't know yet what that change is going to be. But what I like about that is it has come way down. Now, I know Humble just went under another reverse split. FNGU just went under a reverse split. It was down to about 5 something. It's now in the $53 range, having done a reverse split 10 for 1. And NEXCF, which I talked about some before. The other thing is cash. I think 2023 is going to be a tough year for investors. I think we're going to probably end up a year from now with 2023 having been in, as far as the overall markets. My suspicion is, and again, no one has a crystal ball, so I'm trying to predict the future based on what I know at this point. My suspicion is that 2023 is going to be a lackluster year for investors. We will either be up marginally or down marginally. And we have rising interest rates. We have rising energy prices, as you know. And so I think that's going to be one of the reasons that we have a lot of drag. The good news is, I think politically, that the Republicans took control of the House. The Democrats took control of the Senate. And that means that neither side, neither party is going to be able to shove things down the other's throat, as the Democrats were able to do with even a very slim majority. And as you probably know, in the Senate, they only had, it was a 50-50 Senate. We may go back to a 50-50 Senate if Herschel Walker wins the runoff on December 6th in Georgia. But if not, it doesn't really matter, because either way, the Democrats are going to control the Senate with the vote of the vice president. But the Democrats had some real big bills passed, as you know, trillion-dollar bills that I would say led to, not exclusively, but certainly contributed to the inflation that we're all suffering from. That said, politically, and this is money and politics, it's going to be better that we have divided government, because it is tapping the brakes on any either side having the ability to pass what we might call extreme measures. That won't happen. That said, let's get over to some talk about some of the things that we've looked at. And I know this looks like a bowl of spaghetti because I have so many things in here. One thing, and this is a one-year chart I wanted to bring to your attention, is let's look at the black line. Oil play has been very good, and that is DIG. I did talk to you about DIG. DIG is a 2 times leveraged index on the oil companies. Over the last year, it's up 137.6%. That's the black line. Oil has been good. What do I think for the future going forward here? I think that we have probably had most of the money out of oil, although I think it could still be, it could still go up, but I don't think it's going to go up as dramatic. I think most of the money has been made in the oil companies. This could be a good time if you want to have dividends, to look at some of the oil companies, things like ExxonMobil, and Occidental Petroleum and the like. I don't follow those stocks in great detail, but there are some dividend plays on the oil companies that if you want cash flow, you could do that. That said, let's take a look at this chart. And so we got the black line, that's DIG. This, again, is a one-year chart. In second place, and I'm going to take myself out of here, in second place is, by a nose, the purple line. It looks like the gold line, but actually the purple line there came in second. That is also somewhat of an oil play. FCG is an index on natural gas. Natural gas is going to be going up. the Biden policies have contributed. They're not the only thing going on, but they have contributed, the war on fossil fuels, to oil prices going up. And natural gas, therefore, has gone up in price. And you probably have a hard time reading that, but that's let's call it 51% in the last year. Okay. In third place by a nose is a short. That's the gold line, and you can see how good the gold line has been over much of the last year. It has dropped recently, but that is because the NASDAQ recently has gone up. So that's S as in Sam, QQQ, and that is up on the year 42.5%, which means it's been a very bad year for the NASDAQ. The NASDAQ, the opposite of the SQQ, is the line at the very bottom. That's kind of a mauve line right by where it says money and politics. That is down 73%. That is the TQQQ. So you want to buy the SQQ, the gold line, as a hedge on your investments on the NASDAQ. And I always, when I do buy that, I buy it with the idea that I'm going to be holding it for a very limited periods of time. That's more, I will jump in and out of it. In June, and we can see here, if we go to back to about June here, we were up a lot more in the SQQ, because the market had really taken a nosedive. And of late, where the NASDAQ came down, the NASDAQ went up, what we see is that of late we had this recent drop in the SQQ, that gold line here. Now, what do I think is going to happen? I think 2023, as I just said, is going to be overall more or less a dismal year for the overall market. So SQQ is something I would not go, let me say this, I want to emphasize this. Don't go crazy putting a lot of money in the SQQ. It's more of a hedge. When we get, I think as an example of these up days that we've had the last couple of days, I think that is an up market in a bear cycle. And when we get up days in a bear cycle, the way I would play that is I would take some money off the table. If you've got some stocks that went up 5 or 6 or 8%, you don't have to sell the whole position, but you might trim the position. I just the other day, INMD, which I love, and I just talked to you about it, INMD went up a lot. I mean, at one point in the day, it was up like 18%. I sold a few shares of INMD because I thought I'm going to be able to buy those shares back at a cheaper price in a couple of days. So that's the way to play some stocks like that when you get a pop. On the SQQ, where you're shorting basically the NASDAQ, it's going to go up and down. The SQQ is a 3 times leveraged short on the NASDAQ. When the market goes up and the price of SQQ goes down, that's a time you could buy. Buy 2, buy 5, buy 10. It depends on how much money you have. I might encourage you to buy 1 or 2 shares just so you can get accustomed to having it and looking at the price action. The SQQ, again, I'm going to put myself full screen. Listen to this. The SQQQ, 3 Qs, is not something you want to buy and hold long term. It is not something to buy and hold long term. As I'm anticipating a rough year, I'm going to have some of the SQQ. Let's say I had 10 of those, just for the round numbers, and the way you might play that. As the market falls and the price of the SQQ goes up, as the NASDAQ falls, I should say, and the SQQ goes up, sell a couple. If you got 10, sell 2, sell 5. It's up to you. Take some money off the table. If we get another rally, you can, and the SQQs go down, you can buy those shares you sold at a lower price. So you can trade in and out of the SQQs. But let me go back to this overall thing I want to get through. And so we see, again, in black is the DIG. In third place, we saw the SQQs. And if we go down then to this red line here in the middle, that is the baseline. That's the S&P 500, which over the last year is down 15%, basically, to round up. And I'm just looking at some of the other ones to talk about. And at the bottom, in green, you can barely see it down there, is the green line. I don't know if I can highlight that. Okay. The green line, I had it there for a second, is INMD. And INMD over the last year is down 59%. But INMD continues to make a lot of money. And I want to see if I can, let's see if I can get a chart up here for INMD, because I want to bring to your attention how INMD, let me bring this over, and we're going to go boom. So INMD right now is at 37. It has been down, let's see, for the last month or so. You can see it's been down until just recently. It was at 31. Would I buy INMD now? What I would say is, yes, if you don't have it, I would buy it. If you don't have it, I think INMD is going to be one of the great performers over the next 3 to 5 years, folks. The only thing I talk about that you might bounce in and out of really is the SQQ, but INMD I would buy. Now, and I told you how the article, again, as a reminder, let me just quickly pop that in. Up 58%. Is INMD still a buy? That's from the Motley Fool, and they're saying yes, it is a buy. So the other thing is, let me go back to the chart, and you see on the news here, off to the left, INMD shows improved technical strength, hits key technical. I don't want you to necessarily be a technician, but let me point out, I want to get myself out of the shot here. And as we go down, I want to look at INMD. Look at these are their quarterly earnings, and in every instance, 1, 2, 3, 4, the last 4 quarterly earnings, they have beat estimates. They continue to beat estimates every quarter. Look at the growth in their revenue numbers in green. In 2020, their gross top line was $206 million, and last year it was 357. That's a 1 year, from 206 million in 2020 to 357 million in 2021. And this year, and the calendar year and their fiscal year coincide. So when we close out this year, this fiscal year, which ends at the end of December, I think that instead of the revenues that they had in 2021 of 357 million, I think INMD is going to be closer to 455 to 460 million. Look also at the blue line of their earnings. This is what you want. So you're getting strong earnings. Last year, on $357.5 million, they had earnings of 164. On my eyes, it's a little blurry here because it almost $165 million in profit. And they are still a growth stock with, I think, a lot of room to grow. So that is that. Let me bring back in the chart, and let me see if I can. By the way, let me make this a 6-month chart real quick before I blow some of the things out. As we see in the 6-month chart, you have NEXCF, which I also have liked. spiking. Now, I hope that over the weekend that Thomas, my son Thomas, and I can do a joint appearance and talk about NEXCF. The CEO of NEXCF was being interviewed today by one of the online stock reporters who kind of runs his own business. But anyway, the CEO of NEXCF was making a number of comments. And for 2023, the comments that he made all sounded very positive as far as they're growing their revenues. NEXCF, and let me bring this their symbol up again. Whoops. Let me bring me up, bring that down. Symbol is NEXCF. NEXCF, NEXCF. I'm just going to skim the surface here because I'm already going long. That is currently, I don't know if I got the close, but it's right at about 85 cents. It has been bouncing around from about 65 cents to 90 cents. It did touch 90 cents earlier in the day today, probably in response to the interview by the CEO. What they do, NEXCF, is they make 3D models so that when you go to an online catalog, let's say you're shopping for something like on Amazon as an example, but this is going to, I think, spread to many platforms, and you're looking to buy whatever you're looking to buy. It could be furniture, it could be a rug, it could be tennis shoes. Instead of just looking at a photo, you're going to be able to get a 3D model where you can take that tennis shoe and turn it all around and look at all the different sides, of what it is you're buying. And you're going to have that 3D imagery now instead of just looking at a flat two-dimensional item. If you're buying a coffee cup, instead of, hey, here's a picture of a coffee cup, you're going to be able to put it all around, and you get the idea, go around, and I was just thinking if I spilled my coffee on me, and do that. And they are now, NEXCF are a preferred vendor, according to the CEO, a preferred vendor for Amazon. And he said they are in talks with Target and with Walmart. As I said, rather because I'm already long here, let me sum up. Thomas and I will try to do a show on NEXCF over the weekend where we can go into more details. I would like to have some of the video clips I didn't have time to pull of what the CEO said. But when we are going into 2023 with high energy prices, with the consumer already being hurt, with high interest rates, and that impacts everything, it's going to be a challenging year forward, and this is where we need to be able to pick some stocks, some positions that are going to be good in the long run. The good news is when the market's down in a bear market, it's when you can look at good companies and pick some winners. They don't have to be things that you've never heard of before. I think NEXCF is at 85 cents or so. Could be a very big winner. Could is the operative word. I'm not saying for sure. Again, I don't have a crystal ball, but there are very solid reasons to think this could be a big winner over the next 3 to 5 years. Okay? Where's it going to be a year from now? I don't know. But I would be looking to see if their revenues are growing as much as anticipated. One thing the CEO said is one of their challenges, which is a good challenge to have, is that they have to ramp up their internal staff so that they can meet demand. So that's one thing he said. The other thing is, I would say, if you have the opportunity to put some money in cash, set aside cash because it's going to be a challenging year, do that. And, don't put too much money. And this is true of all things. It was true with Humble. I think people got burned because not only did the stock go down, but they put too much of their portfolio in one position. I have gone over this in the past. I probably should have gone over it more. I did tell you that you always want to have at least 10% of your portfolio in cash. In certain, especially in the good times, you want to be taking some profits. That does not mean you have to close out a position, but I use the analogy, if you're going to have tomato plants, pick tomatoes once in a while. Don't grow tomato plants and have tomatoes and never pick any of the tomatoes. When you have stocks that go up, pick some, sell some shares, build up your cash position, because you always are going to be in good stead to have cash for whatever reason. Emergencies, to go out and buy stocks when they go down. It would be nice to have a bunch of cash after the good years that we had over the last 4 and 5 years. Even 2021 for the S&P 500 was a good year. We were up 37%. I believe that is the best one-year record for the S&P 500 ever. So you got to take, the good times are not always going to last. 7 years of plenty, 7 years of fast. You got to take your profits when you have them. And then in this year, 2023, we want to be stock pickers. So I would put some in INMD, some in FNGU, which is kind of a conservative play. Don't go crazy with any of these. NEXCF and NEXCF, I think, because that could go and be quite a growth stock, the NEXCF. I would put some money in there. That's a higher risk, but again, and then cash. Lastly, I would say on Humble, I'll do an update on Humble when I get up to speed. I haven't sold my shares. I am not telling you that the story on Humble is over. I am not saying that. I think that what we do need to see, and what I want to get caught up on some of this, is Humble has some lines that have the ability to produce, aside from the technology they were trying to bring to market, and hopefully you're still going to be successful in that. But they already, with Tickery, have a business line that could bring in a considerable amount of money. Potentially, they could do hundreds of millions of dollars in ticket sales. And so I'm wanting to see progress on Humble's existing business lines, and hopefully they can get someone that can make that happen. While the tech guys are working on some of the new ways of paying internationally, paying bills and cash management, which we all kind of focused on in the beginning. Hopefully that still comes around, but in the meantime, why aren't we seeing more in revenue in ticket sales, especially now that we're not fighting COVID? So those are some of my thoughts right now. Again, I was kind of thought there's a lot I can't talk about just yet because I need to get up to speed, but hopefully that's somewhat helpful. And I did want to get a video out just to reconnect with you, and just frankly, to get me back into the habit of doing some of these videos. They take time, but they are fun. I've always liked sharing. And I'll say in closing, the purpose of me doing these videos was, and I think I've said this in, back in the day when I was doing them regularly, no one taught me how to invest, and I had to learn on my own. And so I want you to learn how to invest to the extent that I can help you do that. Then I will, and that's the point. And I think one thing I will be doing is focusing more than I have in the past, is, again, structuring your portfolio, how to position your portfolio both for growth and safety. And I did do that, but I'm going to plead guilty that I didn't do that enough, and that hopefully I can help you achieve a little more profitability going forward. Always you want to be investing with the idea that one, you want to basically be holding things, unless I say differently, for 3 to 5 years. The SQQQ is not an investment vehicle that I want you to hold for 3 to 5 years. That's where you want to kind of take some money in and out and try to determine when you're going to jump in and when you're going to jump out. All right. I think that's enough, more than enough for now, folks. I've gone a half an hour. I hope you're all well. I intend to do a video before Thanksgiving, but if we don't connect, either because you're too busy to watch or whatever, I hope you do have a wonderful Thanksgiving. I hope 2022, aside from some stocks, in fact, almost everything being down, I hope it's been a good year for you and your family. I hope 2023, despite it being a challenging year financially, I hope you're healthy and that you have a good year with your friends and family, and that you can find many new reasons to put a smile on your face and to look positively into the future. With that said, I'll see you later, folks. Thanks as always for watching. Send me an email if you want. And again, my email that you can send it to, is not that, is moneyandpoliticsnow@gmail.com, and I will fix the Twitter feed. But if you already know my Twitter feed, then go ahead and send me a note on that as well. All right? Thanks, folks. Take care.